Hey, good morning everyone. David Guy here again, winning stock trading. I'm looking at a lot here, so if I'm not looking into the camera, please, uh, understand I'm trying to navigate the charts. I'm trying to give you guys the information you need as well at the same time. So real quickly, we're going to pick up on the last video. We're going to kind of go back here and look at what's happened in the market since 1996 or so. And then I'm going to ask you one simple question like I promised on the last video. So, and that's something that you really need to think about. I don't care how much you know about investing. I don't care if you think that your broker is the best in the world. It really doesn't matter. The facts are the facts. It's your money. No one's going to take care of your money, the same way that you would. Why? Because it's not their money. It's not going to affect their lifestyle. So, and the cold hard fact is this: I like to deal in facts. I state what's on my mind. What I say is, what I believe, and you'll always hear the truth from me. And this is what the truth is. The truth is, it's sad to say, but probably at least 90% of the people out there who hold Series 6 and hold Series 7 licenses are not qualified, to do anything but sell you products. I mean, because that's what their job is. They're salespeople, in terms of analyzing the market, being technicians, determining, what's going on in the overall market and what's most likely to happen next. Very few are proficient in the way that I am. And it didn't happen for me overnight. I was a broker and I was that salesman that I described for many years. And I got out because, I found out that, when the market correction happened in 2000, and we hit the high in early 2000 after the tech bubble, then, my clients lost money like all the other brokers in the office, or most of them anyway. So, I since 2004, I've been on a mission to find a way to educate all Americans, regardless of income, race, ethnicity, gender, whatever, and I may be redundant in what I just said there, but so what? I don't really care about that. My focus is on helping you. So let's move on right now to this first. This is what I do on a daily basis. I look at what's called the internals of the market. This here /ESU5, that stands for the S&P 500 stock market. These are the futures, which is just a security type that I use every day to make trades on the market and make thousands of dollars thousands of dollars each day, day in, day out. And that's not the purpose of this video, so let's get on to the market. But I will say this, this product will be coming out live, so anyone who wants to watch me and practice this in their, paper trading accounts, you'll be able to do so, whether it be live or whether it be on recording. So let's move on to the purpose of this video. I don't want to get off track too much. So let me go back to the long-term history of the market. Bear with me 1 second. Okay, back now live. Let's go back here to the state of the market over the past 20 years. We're not going to go back in the 87-year history of the market, although I did that previously. Let's go right here. So for the past 20 years, it starts in 1995. We can see that from 1995 up until the high in 2000, we went up from a low around the 565 area to a high of 1552. So, that's a pretty sizable return, probably 200% or so, just off the top of my head. Then we came from 1552 all the way down to 800.20, as we see right here, in September 2002. So basically we had a 50% drop right there, or so, it's pretty close to that. My back study statistics video will show you all the statistics if you really want to know the exact numbers. And then from that low in 2002, we climbed all the way up here to August 2007, September 2007, we hit our high again at that 1552 area. And what happened? Well, look at this. Isn't that amazing? Somehow miraculously, it just started to go back down right at the same level it had back in 2000. Isn't that interesting? Well, you know what? These coincidences, they occur all the time. And, for market technicians, they understand, why they're occurring, when they might occur, and what the highest probability is in terms of when we reach previous resistance levels or previous highs or previous lows or support levels, that what we expect to happen is highly predictable. based on, human behavior, based on chart patterns, and based on the overall weight of the evidence, if you will, on the stock market and the various sectors and industry groups, and the economy, both domestically and foreign as well. So there are a lot of factors that go into being successful at trading or investing, and one of them is to be able to identify the trend and identify what's most likely to happen next. So anyway, moving on, 2007 from the high, by March 2009 we hit our low. My coach told me, we did a conference in Dallas, Texas at the time. He told all the people there, I wasn't one of them, but I wish I had been. He told all the people there that, look, now's the time to start buying. The institutional investors are buying. It's time to buy Facebook, Amazon, Netflix, Starbucks, some of the other companies like that, Apple, and so forth. So what happened in March of 2009? Well, I'll tell you what happened. The institutional investors, the people who manage the pension funds and the annuities and your retirement accounts, the big money managers, they started buying. And when they start buying and they make a decision to do that and to do it, on a regular basis and to get back into the market in a serious way, they put a lot of money back into the market. That drove it all the way to, in 2010 to 1180.69. So we almost doubled, basically in 1 year. Then we had a small pullback for a few months. We had another big move up over 6 months, another little pullback, another little move up, and then so forth. And then we got to this level. So the question was, at this point, do we return to the lows of the past, or do we break out? And what happened in this case, as you can see, is we broke out and we went higher. And so not only did we go higher, but we're on an unprecedented run here where we're now in the 2150 area for the high. So let's focus on that. Okay, so you can see what's happening. Each of these little candles, these are called candlesticks, shows the high and the low for each month in the market. It also shows the opening and the closing for the month as well. And so these are called candlesticks. They're actually called Japanese candlesticks. They were used first in the 1700s by the rice traders in Japan. And so, what these are for us is they're real-time momentum indicators. So, and what I mean by that is I don't listen to the news anytime I make a decision with regard to my money. That's just a recipe for disaster. Most of those people on the news, they don't know what they're talking about. They're also, in large part, sometimes owned and, controlled by those on Wall Street. So, let's focus on what we need to focus on, and what I focus on is what you should focus on. And real simply, whether you believe that or not, you should be focusing on what I do. You don't need to be an expert. You just need to follow something and have the information you need when you need it. And that's where we come in. So in any event, let me show you this example of this candlestick right here. You can see it's tall, it's white, and what this shows us here is the bottom of this candlestick, which we call the wick. That shows the low of that month, and the low this month right there, when I put my cursor on that candle, you can see up here that it was 1820 or so. That's L stands for the low. Now you can see the high was 2018.19 right to the left of that 1820 number at the top. And you can see that it closed at 2018.05. So basically this was a super strong month. Not only did it rally from a low, but it actually closed at almost right at its high for the month. So, that was a signal that, hey, we might be going up. And that was back in October of last year. November, a nice month. December pulled back. January pulled back a little bit. February, we had a nice move up again. But you can see that since February, we've been stuck. And we haven't been able to break out of this range here at around the 2125, 2135 area. So, the question is now, will we come back like we have in the past down here to 1820, down to 1550, or even, 1900, 1950? Will that happen? Well, yeah, we know it will. I mean, no one disputes that. The question is, when will it happen? Okay, and that's what I'm here for, to help you with. Right now we're going sideways in the market. We're in a long-term uptrend. We're also now in a intermediate term sideways trend. And when I say an intermediate term, I mean typically 1 month up to like 8 months or so. And so the question from here is, do we break this area of support? Do we start heading back down? Or do we break out and keep heading up? I'll leave that question to you. Okay, but here's the one question I wanted to ask. So let's go back to the, to the longer term here. Right here, this will be good. So you can see the market has gone up, 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 and it hasn't really pulled back for a long time. So my question to you is this, real simply. Which direction, if you had to guess which direction the market was going to go, would you say up, down, or would you say sideways? Well, I'll tell you what I say is that it's most likely now to go up. Why do I say that? Because we're in an uptrend. Okay, so the 70% probability is that we continue to move higher in the stock market. But with that said, there's a 30% chance we go lower. And that 30%, even though it doesn't happen, the market doesn't reverse as often as it continues its trend, does happen. It does occur 30%, 3 out of 10 times. And, based on my back study of the stock market, going back 87 years, and knowing history of the market, and past performance, and just understanding kind of where we are today in this economy, where we're at in the world economy, the various geopolitical events that are going on throughout the world, and my alert system, I know for a fact that right now is the time to be buying insurance or getting ready to buy insurance on the stock market. Why do I say that? Well, real simply, it's going to protect you and your assets, any assets tied to the performance of the U.S. stock market. That's why. It's that simple. That's why we buy insurance for anything. Sometimes we're forced to buy it. Sometimes we buy it because we want to protect ourselves. And so, I just encourage everyone listening on this video to do two things. One, ask yourself, where is this most likely to go? You make the decision. You study the facts. Don't trust me. I don't expect you to. Do your due diligence and then make that decision. And then secondly, make a decision on whether or not you're going to take control of your financial future, or if you're going to leave it in the hands of the brokers, who most of which don't really know what they're doing, except for selling. And this is not a knock on financial advisors, so please understand if you are one, not a knock on you. In fact, the information I provide will be made available to financial advisors. Anyways, I'll cut this short now, and stay tuned. There will be a lot more videos this week and next week. Today I'm going to get back to my focus on building this business and getting it launched by Friday. So have a blessed day, and thank you for listening. Bye for now.